an aggressive tilt, regionally speaking, towards US risk over the last year or so. In fact, the middle of the year more so. Now people are thinking about getting back into EM. You're on board with that?
We are broadly on board with that, So let me just give you a bit of a sort of a history. Sort of in February we went 100% US, and then we reiterated that 100% in May. We say buy in May and go away and buy only US, So towards the late summer, we did notice this massive divergence, almost unprecedented divergence between US and the rest of the world. So we said, look, it's not completely crazy to start adding here emerging markets, So that was kind of late summer, and then last week we actually said, okay, we're now tilting it equally. We're making this barbell portfolio, US plus emerging market, So it's a bit of a sort of contrarian call, I have to say. Emerging markets are obviously more volatile. We do think there is more upside, So if you look at the S&P, our target for S&P is 3,000 for this year. So that's a few percent from here. On EM, we think, albeit with the more volatility, we think the upside could be 10-15% over a bit longer period of time. So call it 3 to 6 months. But we think it warrants allocation now.
So Dubravko, let's be clear here. This is not because you think the story is too expensive in a vacuum here in the United States. It's a relative trade for JPMorgan.
Yeah, I think it's more of a relative trade. If you look at valuation in the US, it's in line with historical averages, medians. And keep in mind, the cash levels, the buyback story in the US, they're pretty ample. So that continues to support a valuation argument. So I think it's really more relative.
So where does the convergence come from? What's really going to drive it? We just caught up with Mike Wilson from Morgan Stanley, who sounds pretty bearish about the international story right now. He characterizes it as rolling bear markets that you see through EM, even see it in Italy with BTPs, and you see it in the United States as we get a little bit more defensive. What do you say back, Marco?
Sentiment is bearish, no doubt about that. But we think that actually this almost extreme and consensus bearish sentiment probably presents an opportunity. So if you look at the price action, if you look at the valuation spreads, EM is already in a bear market, and some of the markets like China even a much bigger drawdown. So we don't sort of discount the risks. The risks are there. Primarily that's a dollar, that's a Fed, and that's a trade war. We do think that a lot of it is already in the price. So now in terms of catalysts, our economists expect convergence of economic numbers next year, so not right now, but sort of sometimes next year, and we have a sort of China starting to add stimulus. Also in US, we have, I think, a sort of a peak growth in US at 4.2. We do also expect that to start moderating. So sometimes next year, early next year, we expect this convergence to start happening. Now, our thesis here is, if the convergence is to happen next year, equity markets, they typically look forward 3 to 6 months if you look at the back test. So 3 to 6 months from now, if you see economic convergence, that means that maybe you should be starting to add here for emerging markets.
So let's talk about the United States, Dubravko. Do you think we are in that phase where we're starting to form a cycle top? Do you see that happening?
So I do think that 2018 was a blowout year in terms of earnings, call it 24-25% earnings growth. Next year expectations are for about 10%. I would probably argue that the second derivative in terms of further accelerating to the upside becomes increasingly more challenging next year. But I think the one big unknown that we need to get more clarity on is what happens on the trade tariff side. So in other words, if we do get 25% implementation come January, then I do think there is downside, potentially significant downside to earnings numbers. Call it, instead of getting 10% growth, maybe you get 7 or 6% growth. But absent tariff escalation, I think, again, maybe not as much upside, but we do see more range bound.